This is Platform Diaries with Shane Williams, who chews the fat with entrepreneurs, startup founders and thought leaders on what it takes to traverse the wall between startup and scale up.
So you've come up with a great idea and you're ready for that next stage of growth. It's probably time you tap the VCs on the shoulder, right? Stick around to find out more about your investment options. You're listening to Platform Diaries and I'm your host, Shane Williams. My guest today is Jordan Green, serial founder, successful venture capitalist and founder of Melbourne Angels. We discuss the myths about startup investment, talk about some great Aussie success stories, some of the biggest mistakes that founders make, and Jordan's top 3 tips for securing the right investment to grow your business. I'll trust you'll enjoy the interview. So Jordan, thank you for joining me on Platform Diaries.
It's my pleasure to be here, Shane. Thank you.
Mate, now, we've got to know each other a little bit over the last month or so, and one of the conversations we had recently really sort of sparked my thinking, and it was a real eye-opener for me. And so I appreciate you coming on today to let me explore that a little bit further with you. And to that end, I might just jump straight in with the heavy-hitting question, which is, what do you think is the biggest myth about startup investment?
Yeah, well, I guess the way I look at it from the investment perspective these days, what's promulgated around is the idea that every startup absolutely must go out and get investment. Sure, it does take money to grow a business, but that doesn't mean that it has to get investment capital. And frankly, the companies most appealing to most startup investors are the ones that are able to generate their own capital, their own revenue. So it is a bit of a conundrum. And I think people take it one step further, and this is particularly promulgated, I think, through a lot of the accelerator programs, that not only must every startup get investment before it's really done very much, but also that it must get VC investment. And that's what I refer to as the VC pipeline myth. The idea that first you get some founder funding and then maybe some accelerator funding or family and friends, and you do a little bit of something. You probably haven't got to generating revenue yet, and then you go out and you try and get some formal investment, perhaps from some angel investors, and then you go on and get some VC investment, and then you go on to a public listing, perhaps. Now, that's a possible pathway. It's the least likely to succeed, the hardest to navigate, and sure, if you do get through all of that and succeed at it, it's likely to have the biggest outcomes. But it's really not a pipeline. Different investors have different approaches to the capital that they're using and to the types of companies that they invest in. And so there are many multiple pathways, and it's not necessary that these things go together. And let me give you some stats to try and explain what I'm talking about. So in Australia last year, angel investors invested in about 17 times more companies than VC. So if it was the pipeline model, that would mean that the angels knew that only 1 out of every 17 companies they invested in was likely to have any chance of success. So that doesn't sound like a particularly good investment thesis. And then when you realize that most VC investments have no angel investment in them at all, you realize that if it truly is a pipeline and the only path to success is through VC, then the angels are basically wasting their time, right? And that's not the case. And certainly all of my best returns on my angel investments have been from companies that have not taken on VC investment. So let me illustrate with one other example why this different pathway issue can be really important for founders. So in a segment of the market called direct consumer retail, which was being on and off quite popular for the last 10 years or so, one of the darlings of that sector is a company called, and I admit these are US examples, you'll forgive me, but it's the best place to get the data that's available. One of the darlings of the sector is a company called the Dollar Shave Club. So the Dollar Shave Club was founded in 2012, and over the next few years, it took on over $160 million of venture capital investment. And then in 2016, after about 4 years, it exited to Unilever for $1 billion. So on the face of it, if those VCs who invested $160 million and more were looking for the nominal 10 times return, they couldn't get it. No matter what they did, there was only $1 billion to share around, not $1.6 billion. So they didn't get what they were looking for. And of course, when VCs invest, it's the nature of the investment, not because they're bad guys or anything. It's the nature of the investment that they tend to take the opportunity to get their return in preference to all other shareholders in priority. So in that deal of $1 billion return, the founder actually got less than $30 million. Now, I think any of us would be happy to have $30 million in our pocket, but to be the founder of a company that sold for $1 billion after 4 years and to only get $30 million doesn't sound like a great deal. Now, on the other hand, there was another company in that sector called Native. So Dollar Shave Club was all about selling razors and personal grooming online. Native was a natural deodorant company. And Native, they took on just over $500,000 of angel investment in 2015 when they were founded. And that bought less than 10% of the company at the time. I forget the exact number, 9 point something. And then 2 years later, Native was sold to Procter & Gamble for $100 million. Okay? So that's a $100 million exit versus a $1 billion exit. In the $1 billion exit, the founder got less than $30 million. In the $100 million exit, the founder got more than $90 million. So that doesn't mean it always works out this way, but just to illustrate that there are these different pathways and the path to success. Oh, and by the way, just to be really clear, it's not clear from the public record whether there were angel investors in Dollar Shave Club, but if they were very early and very small, and they would have got a tiny, tiny fraction, if anything, out of the exit. So both the early investors and the founder did way better in the angel-only pathway, which admittedly had a much smaller exit, 1/10 the size of the big exit, but more than 3 times the size of return to the founder, and presumably also probably to the angel investors.
Mate, that's really fascinating. And I think that'll be a really good basis for which probably leads into my next question is those are good international examples. When you think about some Aussie success stories, and we talk about the definition of good being, I guess, founder and angel investor return in this case. What do you think are some good examples, Aussie success stories for us?
Sure. Well, so first of all, let me say there are lots of them. So anyone who thinks that there is not success in startups in Australia is completely misunderstanding the lay of the land. And it does always depend, giving us a model for success for the founder and perhaps for the early investors. But let me just run through a bunch of them. So hopefully people have heard of a company called Catch of the Day or catch.com.au. Now, that was fantastic for the founders, a fantastic outcome because the founders did actually seek some venture capital investment early in the cycle, and the VCs looked at them and said, no, we're not interested in you. You're not going to do anything good. So, the founders were a bit annoyed and disappointed, as is understandable, but they went ahead and built a fantastic business. And when some years later the VCs came knocking on their door, they told them to piss off because they didn't need them anymore. Now, they ended up having a huge exit, and that was a pure founder-driven business. All right. Then we've got another company called Neura who make headphones. And Neura was really, well, it's still going. It's a very successful business, and it's been really good for the founders. Now, their early investors included a bunch of angel investors, but also Blackbird, the VC. And they're also a company that's really good for customers because their product actually delivers a beneficial outcome for the customers. So there are a lot of companies that customers get value from because they use the service, but Neura produce these headphones that offer vastly superior sound, and actually for many customers, sound that they could never have heard previously. So it's really quite a good product in that regard. Then we've got another one called Airwallex, and again, hopefully people have heard of this one. It's been a stupendous success for an ambitious group of Melbourne founders who built a regional and now global financial services business. And they're valued in the multi-billion-dollar range. And they did eventually take on investment capital, VC capital, but not until they'd already built a substantial business. And if I skip ahead, that's similar to the story with Atlassian, which I'm sure everybody will have heard of by now, where the founders built a strong revenue-based business before they took on any investment, and then they took on some substantial VC investment. And that's a listed company. So now everybody's got a chance to approach liquidity through the listed markets. Another one that much earlier on probably set this trend was a company called 99 Designs. From a suburban Melbourne setting, 99 Designs grew to dominate the entire world for online graphic design projects. And it was only after they were already the global dominant that they finally took on some VC investment. And at the time, really were able to take it on their own terms. And a substantial portion of the first round, if I remember correctly, the first round was in the order of $35 million US. And a substantial portion of that, undisclosed, went to the existing shareholders. So it went to the founders and the early investors as an early partial exit, which again is one of the successes for founders you can get if you build a strong business before you start taking on a heavy amount of investment. Then, of course, people who have heard of Canva, which has been great for the VC community in Australia. My personal favorite in my sort of direct experience has been a company called Rome to Rio. So that Rome to Rio there's two really smart founders. The company was born and bred in Melbourne with the purpose by the founders, the intent to grow a globally dominant business from Melbourne, to stay in Melbourne, to take on investment from Melbourne, and to show the whole world that you can build a globally significant tech company from Australia without having to chase all over the place or move away. Now, they did exactly that, and they grew to be very successful. They have been purchased by a German-based online travel agency, because Rome to Rio is all about multimodal travel itineraries, being able to go from my front door to the front door of my friend in Finland. And with less than a second, Rome to Rio will show me all the steps to get there, where to walk, what bus to catch, what ferry to take, what car share I can use. And yeah, somewhere in there, there'll be flights, which is what everybody else will give you, but they give you the whole thing. And that company continues to be based in Melbourne, to have its own brand, to grow and thrive, produce employment, tax revenue. So it really is, to me, a showcase of what's great about doing a really good Australian startup that continues to fuel the Australian community and the ecosystem. And then there are all the other ones that I haven't touched on in the life sciences sector, where, of course, we get both the financial success and the emotional, social success of doing something that helps our lives be healthier, safer, better.
Now, you mentioned Canva there, and I think it's probably one of the brands everybody recognises up there with Atlassian. And I'm sure I read somewhere that although they've taken on VC funding, that they're not making use of it. And I'm genuinely curious about why, if you've got revenue positive and you're doing really well, why you would take on VC funding. You want to kind of dive into that a little bit for me?
Sure. And again, some of what I'm going to say is supposition, because I'm not inside the tent on this one. So let's start off. Canva is online graphic design tools. They started in Perth. They moved to Sydney. They really got going out of Sydney. And their last round of investment was last September, $275 million US. They valued the company, bought 0.5%. So it valued the company at $55 billion. That's massive. Now, around the same time, interviews with the founders indicated that the three founders still own in excess of 30% of the company, and that the vast bulk of the hundreds and hundreds of millions of dollars that they've acquired in venture funding is basically still in the bank. I know that, again, just from public record, I know that some of I think it was the second or third round, actually was used, as I described with 99 Designs. It flowed through back to some of the investors, and it in fact helped make Blackbird hugely successful, because they were able to take a large chunk of money out of that investment round and use it to give that money back to their own investors in the fund, and is actually demonstrating the classic venture capital model for a fund, which is one very successful portfolio company pays for the whole fund. That is, generates the return across the entire fund. And Canva is almost certainly going to do that for Blackbird in that fund, and probably for the other Australian VCs who followed Blackbird into the deal. So I would assume that the first round of venture investment did get used. And we know that at least some of whether it was the second or third, I'm not sure, round got used to produce this sort of early partial exit. But for the rest of it, why would you take it on if you don't really need it, if you haven't been using it? Well, for two reasons. One, it gives you the security of having money in the bank if you need it, and rapid growth needs to be fueled. So it's very, very common that the reason people invest later in the life cycle of a company, when it's already growing strongly, when it may already be profitable, is to pedal to the metal, to really accelerate that growth while the opportunity exists. But another reason is because the investors themselves want the value of the company to keep growing. This company is not worth $55 billion based on its operational performance today. It's generating over $1 billion in revenue and it's profitable. There's no metric by which I would suggest it's worth over 50 times its revenue. So the investment model of VCs is very much about having to keep grow the value of the business, right? And that's why the value jumps very high. VCs don't want to buy a huge chunk of the ownership of the equity, especially in later rounds. What they want to do is buy a decent chunk, but make it valuable. And so to do that, you have to inflate the valuation to make room for the investment. And this is the potential problem, because at $55 billion, if they wanted to sell and deliver even a 5 times return to the last round of investors, well, no company has ever been sold for over $250 billion anywhere, ever. So it's not a trade sale opportunity. It's possibly a listing opportunity, which at least could offer liquidity to the shareholders. But again, the founders have declared, with the full support of their investors, that they don't intend the company to list, at least not in the next 3 to 5 years. At least that was in the news report about it. So this is one where everyone's going along for the ride. Maybe the company could start paying some dividends, but I suspect they won't do that.
So that leads me to an interesting question, which is there's the option to not take on funding at all. There's the option to take on angel funding and then later on potentially VC funding. Or there's the option to just jump straight into VC funding in the beginning. You know, we've talked about a few success stories. What do you think some of the kind of big mistakes or some of the bigger mistakes that founders make in terms of investment?
So I think one of them is taking on too much investment too soon. And this is a real challenge. It's a difficult knife edge that founders sit on. So on the one hand, you'll hear the saying that says you should get as much money as you can when you can. So you go out to say you want to raise $1 million, people offer you $5 million, take it. Well, yes, in one sense, sure, take it, but only on good terms. So you went out for $1 million and that was going to buy, for the sake of argument, 20% of the business. If you don't change the valuation, $5 million is going to buy the whole business. So you don't want to do that. But at the same time, $1 million to buy 20% of the business, so a pre-money valuation of $4 million, that may have been reasonable for the circumstances the company is in. To go out and turn that into a pre-money valuation of $20 million, so that $5 million buys 20% of the business, is outrageous by almost any measure. And the real issue is what happens next. Okay, so when you overvalue a business early on, the problem is you have to keep increasing the value of the business. So if it's overvalued now, and as you move forward, things don't quite go according to plan, and let's face it, most of the time they don't, then the likelihood is you won't be able to justify a significantly increased valuation when you need to raise some more money. And one of the problems about raising money is that you typically then have to keep raising more money, particularly with VCs because of the way their model works, which is they need to keep putting money to work in a relatively time-efficient manner because they have a time-limited framework within their fund of when they have to move their money. So if you overvalue, you run a real risk of coming to what we call a down round, and that is that at the next round of investment, things haven't gone according to plan and you can't sustain even the valuation you had at the last round. So your valuation has to come down below where it was at the last round, which means everybody who's already a shareholder is getting diluted before any new money comes in, and then the new money comes in and dilutes everybody even further. So it's a really difficult thing, very few companies succeed at actually raising a down round. So the data from Silicon Valley for last quarter was that out of all the deals that were done across seed series A, B, and C, I think it was, fewer than 5% of all the deals were down rounds. But that's not a good thing, because what really means is most of the companies seeking a down round didn't get any money at all. They couldn't raise capital, and so presumably the businesses failed. So I think one of the biggest mistakes is overvaluing the business early on. It's a lot easier to keep raising the value, and even to raise it faster than you expected, than it is to have to step backwards. So from an investment point of view, that's probably the number one thing that I see. The other one that's much more debatable is the structure of investment that people take. So convertible notes and safes are getting more popular, but they're actually overall not really a particularly good tool, but it depends on who you're looking at. So a safe, for instance, is a nice, easy example, although the same is true of a convertible note with the cap and discount model. What it means for the investor is that if the company does succeed really well between taking on that debt investment and moving to a trigger round where you convert, is that the investor doesn't get the value increase of the company if the company's done really well. So that they don't get the risk premium, if you want, the financial language, of their investment. Sure, they've got some downside protection, but if you're a startup investor, you should be shooting for the clouds along with the founder for the success, not worrying about whether or not you're going to lose your money, because frankly, the chances are you're going to lose your money in half of all the deals you put your money into anyway. Now, of course, that depends where you're investing. I take the perspective of angel investors where, with my group and Melbourne Angels, for instance, almost everything that we invest in is pre-revenue. We have nothing against revenue. We get very excited about companies with revenue, but we're actually taking that early stage risk. And we're not doing that because we're worried about losing our money. We don't want to lose our money, of course not. But we appreciate the risk we're taking, and we want to get appreciated for that risk by sharing in the upside. And then probably the last one I'll give you about a mistake founders make is taking the money from the first investor who says yes. The early stage investor, the startup investor, is going to be with you for a while. And even if they're not a huge investor, they can be a great help to the founder or a horrible thorn in your side. They can make your journey really enjoyable and successful, or they can make your life a misery and destroy your business. Or they could be completely indifferent and make no contribution, pro or con. The point is, it's your business, and you should be paying attention to what you need and what's of value to you. You should be evaluating the investors and doing due diligence on the investors just as they are doing on you. Because at the end of the day, just like the early stage investor looks at a company, examines everything, but the people are the critical piece, because execution is where the big risk is in an early stage business. The early stage founder should be looking at the investors and recognizing that, of course, the money they provide is extremely valuable. But if you're expecting them to have any other involvement in your business at all, then you need to know whether these people are going to be a constructive part of your team. Are they aligned with your interests? So the alignment piece is early stage investors like angels tend to align themselves with the success of the founders. Everybody has to be aligned to success of the company, because that's the only place you'll get your financial return, from success of the company. But because angels tend to come in so early, they tend to actually align themselves in the investment terms they use, the attitude they bring, and the way they engage with the success of the founders. If we skip forward to an institutional round, which is bringing in a multi-million-dollar round, which is then presenting enough capital to be able to hire a new management team. The thing is, it's not about policy of throwing out the founders or not throwing out the founders or moving them aside from a role. It's about the fact that very few people who start companies are actually the people skilled to lead companies through every stage of growth. That's more the exception than the rule. So the later stage investment, the larger capital investment, tends to align itself more strongly with the success of the company, and by all means have a positive attitude towards the founder, but it's not the same sense of personal alignment. So don't overvalue the company. Be careful of how much money you take, and absolutely be very careful of the investors that you choose.
And I suppose being careful of the investors you choose probably lends itself towards my next question, which is, what are your top 3 tips? I'm guessing that's one of them, but what other advice have you got for founders?
All right, well, so I'm going to take this from the view of what are investors likely to be looking for in the founder and the business proposition. So one of the first things that creates a really compelling founder and proposition for a startup is for a founder to be able to really understand what value they're creating and for whom. So you have to create value for your customers. And in many businesses these days, your customers are not your users. So you have to create value for your users and understand the difference between those two. You have to create value for your channel, how you get to your customers and users. You have to create value for society. You have to create value for shareholders. And that one is almost always directly linked to what value are you going to create for an acquirer. So not every single business will have to be sold in a trade sale, but investors are looking for a financial return. So they can only get a financial return if their shares get sold or if the company throws off cash in dividend streams. So most startups aren't built around dividends. They're built around capital value growth. And realizing capital value growth is either through a sale of your own equity, so the investor being able to sell their shareholding to somebody else, a sale of the entire company, which we call a trade sale or M&A, merger and acquisition, or a listing on a public exchange where then each shareholder gets the option, if the company is successful in the exchange, to sell their shares into the market. So every company will have to think about selling itself in some fashion if it's going to offer a financial return to its investors. The next thing I want to point out, well, this is actually the same issue, that a for-profit business is about generating a financial return, which I've just described. So it's important not to lose sight of that. When that happens, so as we've just discussed about Canva, that may still be years in the future. So all the people who've invested in Canva are very, very happy with their paper return right now, but the vast majority of them can't actually get any money out of the company. The founders are taking their salaries and they're finding other ways to get value from their shareholdings. But most of the actual shareholders, investor shareholders, are sitting back happy that the company is growing, but they have no liquidity. So you have to understand the value, who you're creating it for, and in the terms of acquirers, different acquirers will see different values in your business. But being able to articulate. So I had a founder present to us last week, and then I had dinner with him, and I was so impressed because this guy was able to tell me who his most likely natural acquirer was, why they were that acquirer, why they were likely to want to acquire his business, and what value he felt he had to create, not just at the core of his business, but as complementary value to make him an appealing acquisition. And one of the things he's done is he's noticed that this acquirer, which is a global company, has countries and regions where it doesn't have a strong presence. So since he's building a brand new business and he can go anywhere in the world, he's prioritizing alongside core markets to grow the core value of his business. He's prioritizing entering markets where his natural acquirer does not have good coverage. So if they look at his company for his core business, his core technology, and say, that's something we want in our stable, and they look at it and they say, and by the way, if we buy him, we get a foothold in these marketplaces that we don't currently have a strong foothold, then he's going to be much more valuable to them. And whether it's that particular company that he's using as his model or it's one of their competitors, the thing is he is starting right now building a confident growth strategy for his business that works in creating core revenue, core profit, and value appeal to potential acquirers. I find that a very compelling proposition. So, of course, we have to look at the IP and the execution and all the rest of it. But here's a founder who really seems to be on top of where he's taking this business and what he's going to do with it. So then the final sort of top tip, I guess, is be really, really clear about your unfair, sustainable, competitive advantage. So let me just sort of work backwards on those words. Advantage means that you're able to sell what you're selling with an advantage over your competitors, and everybody has competitors. competitive advantage is that you are doing that, right? It's really a competitive advantage that people will choose to buy from you, or you can sell at a lower cost or in a faster fashion, something that makes you more competitive. Sustainable means that you can sustain that competitive advantage over time, because often a competitive advantage for a startup is all about doing something new in the marketplace, and that's an unsustainable competitive advantage because other people will then copy you. So Afterpay wasn't the first, but they're perhaps the biggest of their type, but there are dozens of buy now, pay later companies in the marketplace. And then the unfair piece is actually to say that really that's what you want. Not that you should do anything illegal, not that you should cheat, but you should find a way to stack the deck in your favor so that your competitors can't copy you. Now, that might be something as simple as getting IP protection for some element of your business if that's available. It's not available for every business. But getting an unfair, sustainable competitive advantage, or if you prefer a sustainable, unfair competitive advantage, really does create the fundamental building block of constantly scaling a business.
Mate, that's fascinating. Thank you. You've talked a lot about, I guess, the investor perspective and potentially, how you help founders, particularly your passion for sharing your experience. And so I wonder whether you could tell me a little bit more about the workshops that you run.
Yeah, no, look, Shane, I appreciate that. I am very passionate because I was fortunate coming up through my career to have more experienced men and women share with me guidance, advice, I guess what these days some people call mentoring. But I think being able to hear from people who have had the experience and are skilled at sharing it is one of the fastest, surest ways for everybody to learn. And there is certainly no one right way to start, grow, or fund a startup. If there was, someone would have figured it out. They'd be an absolute trillionaire and we'd all be copying them. And there isn't, because those people don't exist. So there are formulas that work for certain people at certain times in certain circumstances, but everything changes. So there are, however, values and principles that have really stood the test of time and can help shape the choices that we make about how we start, grow, and fund our startups. So I run a series of workshops, and I guess I've been teaching founders and startup investors for over 20 years now. But the workshops that I've developed are all for the Australian context. I have adapted them into Asia, but they're all for the Australian context, but informed by global experience and data. They're to provide investors and founders and their advisors, because we want everybody in the mix to be on the same page, with a deeper understanding of what's involved in making those decisions that shape the startup. So I do tend to frame them through the lens of early stage investment, because one of the things I'm fond of pointing out is that a founder is a shareholder too. A founder is an investor in their own business. And just like we talk to founders and even larger businesses, how the people at the top have to take time out of the business to work on the business, I think founders have to take some opportunity to step away from being the executive and think about being the shareholder. And I think that's an important perspective to help the founders keep everything in perspective. So I do tend to take that, and I offer founders who participate in these workshops the insight directly from the investor. So there's no other motive than the success of their venture. When you go to workshops presented by lawyers or accountants or training gurus or accelerators or whatever, all of these people have another agenda, a fee-based agenda or something else that they need to get out of it. And that's not a bad thing. I'm not accusing them of anything. You just need to understand what you're getting and who you're getting. So you go to somebody who runs a workshop on how to write a business plan. The chances are they want to get you as a client to help you write their business plan. You write your business plan. And that's quite okay. When you come to the workshops that I run and similar workshops that people run with my stuff, the investor has only one motive. They want to invest in your company. So they're trying to help you be as good as you possibly can be so that you can get the investment that you want and they can make the investment that they want. So most of them are these days are one-day workshops that are held in person, because I find the dynamics of all being in the room together really does work a hell of a lot better. I've done a little bit over the last 2 years, of course, remotely, but it doesn't really have the same dynamic. And I'm always updating things, and they can be tailored to local circumstances. So when I go to another city or another country, I certainly adapt to the circumstances of that environment. Like I said, I've been doing this now across 3 continents for over 20 years. They're never the same, and that's part of why I always get excited, because I've always got something new to share, because the world keeps changing. So I just ran a workshop a couple of weeks ago on investment terms, and we took a much deeper dive into the SAFE than before, because people are starting to use them more. There's actually very few that get used with formal angel groups, for instance, because they're not good for the investors. And we have this view that if it's not good for the investor, it's not good for the founder, if only because it won't attract the investment. So, yeah, I think the workshops are valuable. At the moment in Melbourne, I deliver them under the Melbourne Angels brand, so they're available for all the members of Melbourne Angels. But they're open to the entire community. Founders get steep discount. We give a 61% discount to founders on the pricing. They're not expensive anyway. And if you're interested in finding out when the next one is running, the easiest way at the moment is to just go to the Melbourne Angels website and sign up on the mailing list there. You won't be inundated with information. You'll just be getting information about our public events, which are a networking lunch once a month and these workshops as they come up half a dozen times a year or more.
Jordan, it's been great talking to you. I really appreciate once again sharing your wisdom with me and today with our listeners. Thanks again for your time. We'll talk again soon.
Thanks very much, Shane. I really enjoyed being here.
You've been listening to Platform Diaries with Shane Williams. To find out about how Shane enables digital businesses to scale, please visit shanewilliams.com.au. Thank you for listening.